Friends, you can earn a lot of money from both trading and investing. But which is better, and what exactly are they? You can understand it this way. Trading and investing are two different paths to making money from the stock market. In trading, you can get profit after a short journey, but the path of investing is very long. You get profit after a lot of time. The main difference between the two is time, because in trading, you can make profit in very little time. You can earn good profit in a month, a week, a day, or even just a few minutes. But in investing, it can take a few months, a few years, 5 years, 10 years, 20 years, or even more to earn profit. Now, you might be thinking, if I can get money in less time, why should I wait for a long time? This is exactly the point where understanding trading and investing becomes very important. This should be very clear to you before you start investing. I'll also tell you here that one person can be both a trader and an investor at the same time, meaning one person can do both, but they must know the difference between trading and investment. So in this video, we will understand trading and investing, discuss the major differences between them, and at the very end, I will also tell you whether you should do trading or investing. Understanding the concept with an example. Let's say there's a man named Bobby who opens a sneaker shop. His shop was running very well. He used to buy sneakers cheap from the market and sell them at his shop for a profit. His business was going great. But after some time, another shop opens right in front of his, Victor's shop, and he starts selling the same sneakers at a cheaper price than Bobby. So the sneaker Bobby sold for $100, Victor starts selling for $85. Since sneakers are available cheaper at Victor's shop, why would people buy from Bobby? Since customers stopped coming, Bobby started watching news all day. One day, while watching news, he sees that the brand of sneakers they sell has announced a limited edition collection, and after that, no new pairs will be manufactured. Now here, an idea comes to Bobby's mind. The demand for these sneakers among people is very high, but due to no new manufacturing, supply will stop. Now, Bobby has two options. Option 1. Every morning he goes to Victor's shop, buys all the sneakers for $85, and resells them at his own shop for $100, earning a profit daily. Option 2. Every morning he goes to Victor's shop, buys all the sneakers, and stores them in his warehouse without selling. He stores them for a few months, and once the price of those sneakers rises in the market due to high demand, he sells them for $150 instead of $100, making much more profit. Now, observe. When Bobby was buying sneakers cheap and selling them daily, he was doing trading. But when he stored the sneakers for a few months and sold them once the price rose in the market, that was investing, because he wasn't selling things daily, but rather waiting for the right moment to maximize his profit. Similarly, trading and investing work in the stock market. Just instead of phones, we have shares. If we buy shares cheap daily and sell them at a higher price to earn profit, that's trading. And if we buy shares cheap and sell them after a few months, a few years, 5 years, 10 years, or even more when their price has risen, that's investing. The major difference between them is timing. I hope you now understand the concept of trading and investing. Investing in detail. In investing, people look for shares of good companies. When they find a company that will generate good profit and perform well in the future, they do fundamental research on that company. They find out whether it's worth investing in, whether the money invested will grow or not. If they get satisfactory answers, they put their money into that company. The company then uses that investor money to launch new products, expand its business, hire new employees, increase production, sell more products, and earn more profit. When the company earns more profit, to keep their investors happy, they share a small portion of that profit with them. These small portions are called dividends. Since investors invest for the long term, they get a great reward at the end, but the company also keeps giving small dividends in between, which act as a regular earning for the investor. Trading in detail. On the other hand, traders don't care what the company does, whether it earns profit or not, or what the management is like. They don't focus on fundamental analysis. A trader focuses most on technical analysis, chart analysis. He tracks whether the share price is falling or rising and looks for opportunities in that movement. A typical trader's routine: he gets up every morning, opens the market, picks a share of any company and tracks its price movement. If after technical and chart analysis he feels the price will go up, he buys it at a lower rate, and as the price rises, he sells it to make a profit. Whereas in investing, the investor buys a share cheap and sells it many years when its price has gone up. Differences between trading and investing. 1. Time. Trading is a short-term process. Investing is a long-term game. 2. Risk. Trading has very high risk. Investing has much lower risk. It's not that investing has zero risk. The share price may fall in the short term, but if you've chosen a good company, its share price will definitely rise in the long term, which reduces the risk greatly. Trading is risky because it's like a game. It's like a coin toss. Heads you win, tails I win. In the stock market, instead of two people, many people come together and bet on whether the share price will fall or rise. They place their money with a broker. If the price rises, one group wins and gets the money of the group that lost. The broker keeps a commission from this, and the government also takes its share as tax. In the long run, only traders lose, because if you made money in trading, someone else lost that money. 3. Type of analysis. In trading, technical analysis, chart analysis, price movement tracking. In investing, fundamental analysis, company research, future growth potential. 4. Stress. Trading involves a lot of stress. If there's profit, the trader is happy all day, but if there's a loss, he's stressed all day. He's anxious with every movement of the share price. Investing involves very little stress. The investor simply invests once, occasionally checks in, sees their portfolio has grown, and moves on, because they're not planning to sell it anytime soon. 5. Which has more money? This is a tricky question. In trading, you can make a lot of money in a very short time, but in investing, the amount of profit you can make over time is beyond imagination because of compounding. Money keeps growing and growing. In trading, you can start with less money. You can invest $1,000 to $2,000 and still generate profit. But in investing, putting in just $1,000 to $2,000 won't make you very rich quickly. However, trading also has the risk of losing that $1,000 to $2,000.
I slipped!
In investing, your money may fall a bit but will never completely disappear. 6. Expenses or charges. In trading, you have to pay more charges since there are many transactions. In investing, delivery, you buy the share once and sell it years later, so charges are very low. 7. Learning curve. Both are complex, but in my opinion, investing is easier to learn than trading. Trading is very risky, and only professionals make money in it. About 90% of new traders lose 90% of their money within 90 days. 8. Tax. In trading, approximately 28% tax on profit. In long-term investing, long-term capital gains, approximately 20% tax on profit. 9. Minimum investment. You can start both trading and investing with as little as $100. In trading, you can put money in futures, options, or intraday trading. In investing, you can directly buy company shares or invest through funds. So, what should you do? I'll be very straightforward here. If you're completely new to the stock market, do not go into trading at all. You might think, I'll put in $1,000 or $2,000, make $5,000, then turn that into $100,000 and then $1 million. It doesn't work that way. Even if you make some money in the beginning, you will definitely lose it later, and at that point, you'll get demotivated. So first, learn the basics of the stock market. Start by buying shares in delivery, investing. Track their movement. As you slowly gain experience and understand how the market works, you can gradually start trading. But when you do learn trading, don't invest large amounts. Start small and increase as your experience grows. Also, when starting trading, choose a broker with an easy-to-use interface and no account maintenance or platform charges. You can start with brokers like E-Trade, Fidelity, or others and start trading. However, I'll still suggest only start trading when you're earning your own money and are willing to take the risk of losing it, because many people have lost money in trading. Always stay positive, whether you do investing or trading. Believe that yes, you can earn profit. And if you're a salaried person earning every month and your only goal is to grow your money for the future, then just do investing. You can put your money in mutual funds. There is absolutely no need for you to trade.
Also, guys, if you like this video, then like it and subscribe.